large part of this class will discuss valuation of basic financial instruments, as well as the question why financial markets are as complex as they are in practice. Before we can dive into those details, unfortunately, we first need to cover basic definitions, although I will not quite go into as much detail as Mishkin does in Chapter 2. Financial markets can broadly be categorized along 4 dimensions. The first is debt versus equity markets, the second are primary versus secondary markets, the third are exchanges versus over-the-counter or OTC markets, and the last distinction is one between money versus capital markets. Now, debt finance refers to borrowing and lending, plain and simple. These are equivalently referred to as credit markets, so whenever I use credit or debt for all practical purposes, the term is interchangeable. In a debt contract, one party, the borrower, receives an initial amount of money, referred to as the principal, and promises the lender repayment plus interest over a fixed amount of time, referred to as the asset's maturity period. Debt markets are separated into short-term markets with a maturity of less than 1 year, intermediate markets with a maturity in between 1 to 10 years, and long-term markets with a maturity exceeding 10 years. Common debt assets are loans like mortgages or bonds issued by corporations or the government, which are simple IOUs paid back over a fixed amount of time. The second fundamental form of financial exchange is equity, and its most common form, this refers to stocks or shares. Stocks of a firm are titles of ownership and entitle the holders to profit shares of a corporation. Such profit shares are paid out in the form of dividends, although a company may choose to reinvest profits and not pay dividends at any point in time. Similarly, equity is considered subordinate to debt in the sense that holders only have a claim to payments after the firm has paid off all its debt. This makes equity riskier than debt, since a firm first has to make a profit at all for equity to pay a positive return. However, corporate limited liability limits downside risk somewhat. If a firm goes bankrupt, stockholders are not liable for the firm's uncovered debts at time of bankruptcy. Equity titles do not expire, they live forever, and technically thus have infinite maturity. Stocks are therefore considered long-term securities by definition. In comparison, the size of the debt market is slightly larger in developed nations like the US and typically much larger in emerging markets. Since debt plays a more central role in the macroeconomy than equity, banking crises tend to have a larger macroeconomic effect than, for instance, stock market crashes. And in the same way, we're going to focus a little bit more on credit and debt markets in this class, although we will cover stock markets as well. Primary markets refer to the initial offering of financial assets. These can occur as initial public offerings or IPOs, typically of stocks or bonds, to, for instance, preferred shareholders or the broad public, or, for instance, in form of loan originations by bank or finance companies. Financial investors exchange existing assets among each other, by contrast, in secondary markets. Secondary markets have an important signal function for IPOs. If a new tech firm issues stock, for instance, prices of similar firms trading in secondary markets provide some indication as to how much the firm can expect to raise from its new shares. Notice that the distinction between primary and secondary markets is largely a conceptual one, not a physical one. Shares brought to the newest stock exchange, for instance, for the first time, do not trade in a separate physical location than those which are already in circulation, as an example. Exchanges versus over-the-counter markets. Exchanges are centralized marketplaces in which all buy and sell offers for an asset are collected to determine the price by the exchange. Popular examples are the New York Stock Exchange, NYSE, or the Nasdaq. Exchanges for commodities like oil or agricultural goods, or exchanges for financial derivatives, that is, an asset derived from another existing assets, such as, for instance, interest rate forwards or swap contracts, also exist within the United States. In practice, however, most financial exchange occurs in a decentralized over-the-counter fashion. Over-the-counter fashion simply means that two parties settle on contractual terms without a central clearinghouse. This includes, for instance, the US mortgage markets or that for treasury bonds, as well as that of many financial derivatives in practice. Final distinction, money versus capital markets. Final distinction is one between so-called short-term money markets with a maturity of less than 1 year and longer-term capital markets with a maturity of more than 1 year. The name derives from different borrowing purposes. Many borrowers use short-run debt to meet due liabilities, that is, to raise cash, while most borrow long-term with capital investments in mind, like to purchase a machinery or buildings, for instance. Money market instruments, by definition, have to be debt instruments, like treasury bills, commercial paper, certificates of deposits, repo agreements, or federal funds borrowing, just to name a few. They cannot be stock investments because stock does not expire. Capital markets then include all such equity investments, as well as long-term debt contracts like mortgages, corporate or government bonds, and so forth. With these basic definitions in mind, we move on to the distinction between direct and indirect finance. In many ways, direct finance using bonds or stocks seems like the more intuitive form of exchange. After all, why would you include a costly middleman like a bank or mutual fund that will not process the exchange for free if you can trade directly? Now, empirically, as it turns out, and this is what this graph illustrates, most finance is debt finance, and B, most is indirect. That means it occurs with the help of a middleman, a financial intermediary. This graph lists overall domestic credit for high-income countries as a percentage of GDP. That's the orange line, that's the size of the debt market in the average high-income country. It also lists domestic credit provided by banks. That's the gray line, which is the portion of debt that is provided through financial intermediaries. And finally, it lists stock market capitalization as a percentage of GDP, the blue line. This is a proxy for the size of the stock market. Now, looking at these lines, it should be evident for one that debt markets are larger than equity markets, and this holds true for pretty much all countries in terms of size. In part, this explains why macroeconomists often focus more on credit markets than they do focus on stock markets. Similarly, the gray line makes up for more than half of outstanding debt, signaling that most debt is provided by financial intermediaries. This line only includes banks. I'm not even including, say, insurance company or mutual funds in this. So in other words, financial intermediation really is the status quo. Direct finance is much less common, and it's usually something that's only accessible to larger corporations or the government. This raises the question, which particular economic service such financial intermediaries provide? Why are we using them in the first place? The textbook answer to this is that financial intermediaries are A, reducing transaction cost. This is an economies of scale argument. Large financial institutions, for instance, can bundle orders of assets, which reduces brokerage fees. In a similar vein, financial institutions, by virtue of holding onto a bundle of funds, can provide investors with cash if needed temporarily. This is sometimes referred to as liquidity services. The second argument for why financial institutions are beneficial is one of risk sharing. Imagine, for instance, a borrower that tries to raise funds for a 40 million production facility. Now, if there were only one single lender, funding this whole operation brings huge downside risks. However, we can split the 40 million among a few thousand or potentially even millions of lenders, let's say. Each individual lender's risk share is much more limited. Now, banks obviously have access to millions of lenders because a lot of us deposit the funds in banks. But it is not really all that clear why you need a bank specifically for that instead of using, for instance, a bond market that can also break down the risk. Now, the answer to this last question is that the most important and central function of financial intermediaries addresses the main market failure really present in financial markets, and that's the one of asymmetric information. Now, if you don't know what asymmetric information is, generally speaking, it refers to a situation in an exchange where one party is better informed than the other, and that leads to distinct types of market failure. The first is adverse selection, which is an informational asymmetry that occurs before a contract is made. In this context, what happens there is that the bad risks are selected instead of the good ones. We'll explain that in detail later on if you've never heard of this. The other type of asymmetric information economists worry about is moral hazard, which occurs after a contract is made. This is also sometimes referred to as a principal-agent problem, and again, we'll discuss that in more detail later on. Now, the critical function of financial intermediaries is the provision of information to facilitate such asymmetric information problems. They understand the borrower pool better, they might understand, for instance, the corporate sector better, and the idea is they help you make better financial decisions. Now, why do such informational asymmetries exist in the first place? And that's the fundamental problem of finance. Financial market transitions are not quid pro quo. What this means is they are not immediate. And in that sense, they are very unlike other transactions. For instance, if you buy food at the store, you take the good, you pay for it, and the transaction is complete. However, if you buy stocks or bonds, what you receive initially is simply a promise of future repayment, and that generates inevitable risk. You never know if your borrower, for instance, is able to repay further down the road or is willing to repay further down the road. And that is something the borrower typically understands better. There's nothing we can do about this in principle, but we have developed ways over the centuries to at least mitigate these risks.